We got some good news on inflation this morning, which initially caused markets to rally, and then Walmart came out and they said that they're making more money than expected, which helped their stock rise. Now we have seen the stock market cool down since the morning. And then later on today, on Tuesday, November 15th, we also got a new report on household debt. And what it said is we are seeing household debt levels rise at the fastest rate in 15 years, partially because credit card debt is growing extremely fast. So let me start by talking about the new inflation data that came in, because today we got our PPI numbers, which is our producer inflation numbers. This is the wholesale inflation number, meaning the inflation that business owners have to pay. So when we talk about the CPI, that's the inflation that you pay when you go buy something from the store. Well, when the store or the manufacturer has to produce their actual products, the inflation that they pay is called the PPI. It's the wholesale business inflation, and the numbers came in better than expected, which is what initially caused markets to rally. So the number came in that in October, the PPI rose by 0.2%. Instead of the 0.4% it was expected to rise, and the annual PPI is 8%, which is less than the 8.4% we got in September. So still extremely high inflation for business owners. It's better than expected, better than previous months, and this is what caused markets to rally, because kind of like what we saw when the last consumer inflation numbers came in, everybody said, oh, this means that the inflation fight is over. The Fed's going to start pivoting. The Fed's no longer going to continue raising interest rates. The Fed might start cutting interest rates. And so that's what caused markets to rally then. And you kind of saw something similar happen today. And then you had a number of economists kind of come out and say, no, don't expect the Fed to start cutting interest rates. I already covered that in a previous video. Now, if we move now to Walmart, Walmart put out a very interesting statement, because Walmart saw their profits grow by more than expected, and their CFO kind of indicated that the reason why their profits went up so much was because of two things. First, he talked about because we have a high inflation level in food. He says that we're continuing to see high food prices, and inflation numbers, according to Walmart, this is according to the CFO, are in the mid-teens. So double-digit inflation on food. And so people are now not buying the higher quality foods. They're now downgrading to some of the lower quality foods, which he said has contributed to higher profits and higher revenues. But the second thing, which is probably the most interesting thing that he said, which has contributed to the last quarter's gains, was Walmart was helped in part by a growing horde of households making $100,000 a year or more now shopping at Walmart. So you have more and more people that are no longer going to Whole Foods or Trader Joe's or the other stores, and now they're going to Walmart, and because of that, Walmart has been benefiting. And then Walmart went on to announce that they're going to do a $20 billion, B for boy, $20 billion stock buyback. And so that was a big reason why their stock soared, because now their corporation is going to spend $20 billion buying back their own stock. So their stock rallied. Now, this brings me to the third important story of the day, which has to do with credit card debt. Now, we've been covering our national debt levels and our household debt levels pretty in depth on market briefs. If you haven't joined market briefs yet, I'll put the link to how you can join down in the description below. But it's a free newsletter that keeps you up to date on what's happening in the markets. That way you can make better decisions with your money. So our household debt levels broke a record in August of this year, August 2022. And this latest report, which came out by the Federal Reserve Bank, they said that between August and now, our household debt levels have been growing, and they've been growing at the fastest rate in 15 years. So it's the fastest rate since 2007, right before the financial meltdown then. And the things that contributed to this growth in household debt were, number one, mortgages, number two, credit card debt. And you had an economic advisor from the Fed say this, quote, credit card, mortgage, and auto loan balances continued to increase in the third quarter of 2022, reflecting a combination of robust consumer demand and higher prices. So, according to this Fed economic advisor, the fact that people have more debt, more credit card debt, more auto loan debt, more mortgage debt is proof that people have the ability to spend money and our economy is strong. Now, maybe you can argue that with mortgage debt, but when you're talking about credit card debt, especially, which was one of the fastest growth numbers that we saw in debt, I don't think that is proof that our consumers are strong. Yeah, they have the ability to spend, but does that mean that the consumer is healthy? It's a different definition, different people's goals because, well, how does our economy work? Our economy runs on spending. The more money somebody else spends, the more money somebody else makes. So in the eyes of the Fed economists, if people have the ability to go into credit card debt, that means consumers are strong because now they have the ability to go into debt. Well, the part that they did not highlight, that no one really touched on here, was interest rates. Because, as we all know, interest rates have gone up significantly in 2022. And that really impacts, of course, getting a new mortgage and business debt, but it really impacts consumers at the credit card debt level because credit cards are variable interest rate debts. So when interest rates go up, your payments go up on your credit card, even if your balance doesn't increase. And so what we're seeing happen is, one, people's balance for their credit card debt is increasing, and two, the interest rate on their credit card debt is increasing. So it's a double whammy. And so this is gonna impact more and more consumers going into 2023 because we're seeing the price of everything continue to rise. The Walmart CFO said that. And so people have to pay more money to buy things. How are they buying it? They're turning to their credit card. Now the Fed says this is good news. It shows robust consumer demand. Well, people are now racking up more credit card debt at the fastest rate in 15 years. And then, unlike 2007, we have higher interest rates and interest rates that are rising, which means now the payments on these credit card debts are going to be rising even faster, not just because people's balances are increasing, but because the interest rate on these balances are increasing. So these are the things that you want to pay attention to. This is Tuesday, November 15th, and another market recap.